As we move into February 2026, the global trading system is displaying symptoms that financial historians recognize with unsettling clarity. The recent escalation of trade hostilities, marked by President Trump's threat of a 50% tariff on Canadian aircraft and the continued deterioration of the United States trade deficit despite an aggressive tariff regime, represents more than isolated policy decisions. These are structural indicators of a wealth destruction mechanism already in motion, operating according to mathematical principles that have governed economic collapse throughout modern history. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The immediate trigger points are visible in the data released just hours ago. The United States trade deficit surged 94% in November, jumping from $29 billion to over $56 billion, even as tariff policies ostensibly designed to narrow this gap have been in effect for nearly a year. This is not an anomaly. This is confirmation that the same feedback loops that amplified the Smoot-Hawley disaster of 1930 and contributed to the cascading failures of 2008 are once again active in the global financial system. What distinguishes the current moment is not the novelty of the mechanism, but the unprecedented scale of interconnected leverage, the speed of modern capital flows, and the compression of policy options available to central authorities. The progression is already mathematically determined by the structure itself. When President Trump threatened Canada with 100% tariffs if Prime Minister Carney proceeds with a strategic partnership with China, then escalated to a 50% tariff on all Canadian aircraft, including the decertification of bombardier jets in United States airspace, he triggered a sequence that cannot be reversed through negotiation alone. Canada sends over 75% of its exports to the United States. A tariff barrier of this magnitude is not a trade policy, it is an economic blockade. The difference is critical because blockades, unlike tariffs, force binary choices. They eliminate the gradualism that allows markets to adjust and capital to reallocate efficiently. They accelerate decision-making beyond the capacity of institutions to adapt. The recent data confirms what systemic analysts have been tracking since mid-2025. Despite tariffs reaching their highest effective rates since 1946, with weighted average applied tariff rates climbing to 14% and effective rates at 10.1%, the trade deficit for the year through November stands 4% higher than the same period in 2024. This inversion, where protectionist measures widen rather than narrow trade imbalances, is a signature pattern that preceded both the Great Depression and the 2008 financial crisis. The mechanism is well understood. Tariffs raise input costs for domestic producers, making exports less competitive. Trading partners retaliate, closing off markets. Uncertainty depresses investment. The capital account adjusts to offset the current account, but through financial flows that increase systemic fragility rather than productive capacity. The parallel to Smoot-Hawley is not rhetorical, it is structural. In June 1930, President Hoover signed legislation that raised tariffs by approximately 20% on agricultural and industrial goods, despite warnings from over 1,000 economists. Within 2 years, 24 countries enacted retaliatory tariffs. United States exports to Europe collapsed by 2/3 between 1929 and 1932. Global trade declined by 66% between 1929 and 1934. The Dow Jones Industrial Average lost 23% in the 2 weeks leading to Hoover's signature, with $1 billion in market value evaporating the day he announced approval. The functional operation of the gold exchange standard, which had stabilized international finance since the end of World War I, was destroyed not by monetary policy alone, but by the fragmentation of trade relationships that made coordinated currency management impossible. The current environment presents the same structural dynamic, but with amplification factors that did not exist in 1930. Global derivative exposure as of 2025 exceeds $600 trillion in notional value. The concentration of financial activity in approximately 20 systemically important institutions means that counterparty risk propagates at network speed rather than the pace of 1930s telegraph communication. Household debt in advanced economies reached 138% of disposable income before the 2008 crisis. That ratio has not meaningfully declined in the intervening years. Instead, it has shifted composition. Corporate debt, particularly in the technology and energy sectors, has expanded to finance capital-intensive infrastructure and artificial intelligence development. This debt is priced against assumptions of stable trade relationships, predictable regulatory environments, and continuous access to global supply chains. When those assumptions fail, repricing happens not gradually, but discontinuously. The wealth destruction mechanism from 2008 provides the template. American households lost $17 trillion in net worth, a decline of 26%, with $11 trillion lost in a single year. Global losses exceeded that figure substantially when European, Asian, and emerging market exposures are included. The recovery was incomplete. 10 years after the crisis began, United States GDP remained approximately 7% below the trajectory it would have followed absent the disruption, representing $70,000 in lifetime income loss for every American. Unemployment doubled to nearly 10%. Housing wealth declined by over 20% nationally. The critical observation is that these losses were not evenly distributed. Export-oriented states and industries absorbed disproportionate damage. Financial markets experienced multiple crashes. Banking systems required unprecedented public intervention to prevent complete collapse. The mechanisms that contained that crisis, massive central bank liquidity provision, coordinated international fiscal stimulus, near-zero interest rates maintained for years, are substantially exhausted or unavailable in the current cycle. The velocity of the current deterioration exceeds historical norms. The trade war with China escalated from 10% tariffs in February 2025 to aggregate rates exceeding 100% by mid-year, with retaliatory measures matching each escalation. United States imports from China fell 28% in 2025, while exports to China dropped 38%. This represents one of the sharpest bilateral trade contractions in modern economic history. The differential impact, exports falling faster than imports, indicates that retaliatory measures are more effective than offensive tariffs, a pattern consistent with the Smoot-Hawley experience, where trading partners had more flexibility to redirect commerce than the initiating country. The structural driver that makes this cycle particularly destructive is the persistent savings-investment imbalance in the United States economy. The trade deficit is not primarily a function of predatory foreign practices. It is the mathematical consequence of an economy that consumes more than it produces and invests more than it saves. The gap must be financed by capital inflows from abroad. When tariff policy disrupts trade flows, it does not eliminate the underlying imbalance. It forces adjustment through financial markets rather than goods markets. This means currency volatility, interest rate dislocations, and asset price swings rather than smooth reallocation of productive resources. Recent data illustrates this mechanism clearly. The trade deficit with the European Union expanded from $7.9 billion in October to $14 billion in November, even as tariff tensions escalated. The deficit with Vietnam increased. The deficit with China, while declining marginally, remains substantial. Meanwhile, United States exports fell nearly 4%, while imports climbed 5%. This is the opposite of what tariff theory predicts should happen. The explanation lies in the behavioral response of economic actors facing uncertainty. Businesses front-loaded imports in late 2024 and early 2025 to avoid anticipated tariffs, creating artificial demand spikes. That pulled forward future consumption. When the spike passed, the underlying weakness became apparent. Simultaneously, export markets closed or became unprofitable as retaliation took effect, and the dollar strengthened in response to safe haven flows. The systematic underestimation of these dynamics by policymakers and market participants follows a recognizable pattern. In 1930, advocates for Smoot-Hawley believed protecting domestic industries would create jobs and prosperity. The opposite occurred because they failed to account for general equilibrium effects. Trading partners must be able to sell to the United States if they are to buy from the United States. When exports are blocked, countries cannot earn the currency needed to purchase American goods. They must either devalue their currencies, making American exports even less competitive, or impose their own barriers, closing markets to American products. Both responses materialized in the 1930s. Both are materializing now. The European Union has prepared lists of American goods subject to retaliatory tariffs exceeding $84 billion in value. China has matched every tariff escalation. Canada, historically the most integrated trading partner, has explicitly stated intentions to diversify away from dependence on United States markets. The fragmentation of the North American trading bloc carries implications beyond bilateral commerce. The United States-Mexico-Canada Agreement is scheduled for review in July 2026. The terms negotiated during Trump's first administration assumed continuation of the integrated continental production networks that have developed over 4 decades. Automobile manufacturing, aerospace, energy, agriculture, and advanced manufacturing all operate on the assumption that components, capital, and labor can move relatively freely across borders. A 50% tariff on Canadian aircraft, or 100% tariff on all Canadian goods, if the China partnership proceeds, destroys that integration. It cannot be partially destroyed. Supply chains either function or they do not. The costs of maintaining duplicate production facilities in multiple jurisdictions, managing regulatory arbitrage, and hedging political risk make many currently viable operations uneconomical. This is where the wealth destruction accelerates beyond what occurred in either 1929 or 2008. The Great Depression involved primarily domestic banking failures and trade collapse in an era when international capital flows were relatively modest and financial markets were less interconnected. The 2008 crisis originated in housing and mortgage-backed securities, but propagated through global financial institutions with cross-border exposures. The current structure combines elements of both with additions unique to the 21st century. Derivative exposure vastly exceeds the scale of 2008. Supply chains are longer and more complex. Corporate debt levels are higher. Geopolitical tensions are more acute. The share of global GDP accounted for by international trade is larger. Central bank balance sheets are already expanded from prior interventions, limiting additional capacity. Fiscal deficits are elevated, constraining government response options. Social and political cohesion is weaker, reducing tolerance for painful adjustments. Most critically, the current system operates at higher velocity. In 1930, the progression from Smoot-Hawley to full depression took years. In 2008, the sequence from subprime mortgage stress to Lehman Brothers bankruptcy to global financial panic unfolded over 18 months. The compression of time reflects the speed of information transmission and the automation of trading systems. When uncertainty spikes, algorithmic trading amplifies volatility. When credit lines tighten, the entire shadow banking system can freeze in days rather than weeks. When currency pegs come under pressure, central banks burn through reserves in hours rather than months. The infrastructure designed to increase efficiency in normal times becomes a transmission mechanism for instability during stress. The impact on ordinary economic activity is already visible in leading indicators. United States companies are paying 40% more for aluminum than in June 2025 after tariffs doubled to 50%. This does not reflect increased domestic production capacity. It reflects supply constraints and market power. The costs flow directly to manufacturers who use aluminum in production, reducing margins and competitiveness. Investment in manufacturing is projected to decline 13% annually through 2029, according to congressional analysis, the opposite of what tariff advocates predicted. This is because the uncertainty created by constantly shifting trade policy makes long-term capital commitments irrational. Firms cannot model returns when input costs, market access, and regulatory requirements change monthly. The historical record provides clear precedent for what happens when trade systems fracture under policy stress. After Smoot-Hawley, unemployment in the United States jumped from 8% in 1930 to 16% in 1931 and 25% by 1933. The legislation intended to help farmers destroyed agricultural exports as farm products faced retaliatory tariffs in every major market. Cotton, wheat, pork, and lard are export crops. When those markets closed, American farmers faced catastrophic price declines even as domestic production costs rose due to higher tariffs on equipment and inputs. The political consequences were equally severe. Both Smoot and Hawley lost their seats in the 1932 election. Hoover was defeated by Roosevelt in a landslide. The Republican Party lost control of both houses of Congress by large margins. The discrediting of protectionism was so complete that it took the outbreak of World War II for the unemployment rate to fall below 1930s levels. The difference in scale between that experience and the potential current outcome lies in absolute magnitude. Global wealth at risk is measured in hundreds of trillions of dollars rather than billions. The integrated nature of modern finance means that local crises become global almost instantaneously. The 2008 crisis demonstrated this principle. Subprime mortgage losses in the United States, initially estimated in the hundreds of billions, triggered over $11 trillion in household wealth destruction domestically and comparable or larger losses internationally when European bank failures, sovereign debt crises, and emerging market capital flight are included. The mechanism was financial contagion through interconnected institutions. The current trade fragmentation creates the same contagion risk, but through real economy channels that central banks cannot address with liquidity provision alone. The progression from here follows established patterns. Trade fragmentation forces supply chain reorganization. That reorganization is expensive and disruptive. Companies must duplicate facilities, manage higher inventory costs, and navigate complex regulatory arbitrage. Some firms absorb the costs through lower margins. Others pass costs to consumers through higher prices. Both responses reduce real incomes and consumption. Reduced consumption depresses demand. Reduced demand triggers layoffs. Layoffs reduce income further. The feedback loop becomes self-reinforcing. At some threshold, financial markets recognize that earnings projections are unattainable. Equity values adjust downward. Wealth effects amplify the consumption decline. Credit conditions tighten as lenders reassess risk. Investment falls. The cycle deepens. The specific trigger that converts slow deterioration into rapid collapse cannot be predicted with precision. In 1930, multiple factors combined: agricultural price declines, banking failures, monetary contraction, international gold standard pressures, and debt deflation. In 2008, the trigger was clear: Lehman Brothers bankruptcy on September 15th. The current environment presents multiple potential catalysts. The Supreme Court decision on the legality of tariffs imposed under the International Emergency Economic Powers Act could invalidate substantial portions of existing trade policy, creating legal and financial chaos. The July 2026 review of the United States-Mexico-Canada Agreement could formalize the dissolution of North American economic integration. Escalation with China over rare earth export controls could disrupt technology supply chains. A financial institution failure triggered by concentrated exposures to trade-sensitive sectors could freeze credit markets. The interconnection of these risks means that triggering one increases probability of triggering others. This is what distinguishes systemic crises from isolated shocks. The system is designed for efficiency under normal conditions. That efficiency creates interdependence. Interdependence creates contagion pathways. When stress exceeds the capacity of buffers, the system does not degrade gradually. It fails discontinuously. The 2008 experience demonstrated this clearly. Bear Stearns failed in March. Markets stabilized temporarily. Then Fannie Mae and Freddie Mac required government conservatorship in September. Then Lehman failed. Then AIG required bailout. Then Washington Mutual failed. Then Wachovia failed. The sequence lasted weeks, not months. Each failure made the next more likely because it revealed broader fragility and eroded confidence. The current wealth at risk exceeds both prior episodes by substantial margins. Global financial assets total well over $300 trillion. Real estate wealth adds comparable amounts. Derivative notional values exceed $600 trillion. Even small percentage declines in asset values translate to tens of trillions in wealth destruction. A 26% decline in household net worth, matching the 2008 experience, applied to current wealth levels, would exceed $50 trillion globally. That figure understates potential impact because it does not account for sovereign debt crises, pension fund insolvency, insurance company failures, or complete breakdown of credit intermediation. The comparison to 1929 and 2008 combined is not hyperbole. The mechanisms are identical: trade fragmentation, debt overhang, asset price inflation disconnected from fundamentals, policy errors that amplify rather than dampen volatility, and institutional structures that transmit rather than absorb shocks. The scale is larger because the global economy is larger, more integrated, and more levered. The velocity is faster because information moves at light speed and trading is automated. The capacity for policy response is more limited because tools were deployed in prior crises and have not been fully replenished. The political and social cohesion required to implement painful but necessary adjustments is weaker because inequality has increased and trust in institutions has declined. As we move through early 2026, the trajectory is already set by the structure. The trade deficit widening despite tariffs confirms that the policy is failing on its stated objectives while imposing real costs. The escalation with Canada demonstrates that diplomatic off-ramps are closing as rhetoric hardens and retaliatory measures become politically locked in. The concentration of risk in specific sectors and institutions means that when repricing begins, it will cascade through interconnected networks faster than regulatory or market mechanisms can contain. The historical record shows that once these processes begin, they follow mathematical laws that reflect human behavior in crisis: panic selling, credit hoarding, capital flight, and policy paralysis. The outcome is not speculative. It is the logical consequence of choices already made interacting with structures already in place, under conditions already observable.